and my goal is to make life very easy for us, and hopefully we can make this a conversation for all of us, right? Make life easier for everyone to understand how it should be done, right? um as I said, I'm a software engineer by tradition. I also run a website called SecDiver.com. I will probably talk about it more as we get past the presentation. And as I said, like, don't take this for as advice for buying a particular stock or selling it. Please do your due diligence. Please understand, and markets will teach you to be humbler with time. Okay, so make sure you ask a lot of questions. Let this be a very friendly conversation. Stop me anytime. Again, I said I'm not an expert. Okay. Manjuji, thanks for sharing. You're a beginner. So what's your purpose behind this, Manjuji? You want to call out?
I just want to understand the investment options and opportunity in the equity thing that I never been before.
Got it. Are there any return expectations you have? Like, do you want to make so much X% money? I'm pretty sure all of us here.
No, 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 no. I mean, I just want to see the scope of this equity area in general.
Okay. Okay.
Is that a short term, long term, or
Yeah.
how does that payoff works here?
Right. So mostly we'll be covering long-term investing, Manjuji. So that's the key framework that I'm going to talk about. Okay. I'm not an options person, so mostly everything should be long-term oriented. Okay, like 20 years, 30 years down the line. Okay. So hopefully by this presentation, right, you should be able to, I guess, have a framework or a process to value, to understand stocks, right? What price to pay, and how do you define the margin of safety, right? So that you feel good when the market, when chips are down, when the market is down, can you still maintain a cool and keep those good investments? Okay, so we'll explore some concepts like CAGR, present value. Again, if you know that, that's great, but if you don't know, we'll probably cover it if time uh, progresses. Okay, am I going a bit faster? Is it fine? The pace is fine with everyone? Okay, so I'm hoping that after this talk, no one will say I'm buying a stock. They'll say I'm buying a business, and and um, and you will learn with time that, like I would say, like 20 years back, 10 years back, there was this concept of, like, there was no internet, information was not there. People need analytic skills, but now I feel like it's mostly all the information is there. It's at your fingertips. It's mostly the behavioral edge that counts, right? Are you able to stay? Do you able to have the courage? And you'll see why I call that out, right? And I guess if you have that contrarian mindset, you're gonna make a lot of money, right? Uh, um, so the way we gonna go over each of the stocks is like more of like the mental model would be like, okay, how do you what kind of family members do you like, right? How do you want your friends to be, right? How do you want your kids to be growing up, right? So we'll talk about those things, and you'll see how this themes are coming through in the business world, right? So as everyone said, right, if you avoid bad people, right, and give relationships time, right, you'll always have a wonderful life ahead, right? So that's the core thing that we're gonna see as we progress ahead, right? um, okay, so um, let me ask you a quick question, right? Let's say you're walking on the road and there was $100 bill lying on the road. How much would you pay for it? PSG, do you want to say? How much would you pay for it?
It's worth $100.
On the, yeah,
Um,
it's visible.
but I'm trying to understand the question. So how much would I pay for it?
Yeah.
Um, so if I pay $100 for it and I get $100 back, then I didn't gain anything.
Yeah, so it's there. How much would you pay for it? So that's okay,
You
but
said anything less than 199 maybe.
actually love that answer. Yes. What if there's a $100 bill? You know it. It's inside a purse. It's lying on the road, right? Only you know it. Someone else don't know it, right? What would happen? Do you think in that scenario?
So no one else knows there's money in the purse.
Right. So you know it, right? Right.
Then I'll pay as less as possible, like $1.
Exactly. Right. And I think that is what we as investors needs to do. We need to look for those $100 bills and pay less money, right? And whatever you call it, right, that's called the margin of safety. In this case, you're talking about paying $1. That's like a $90 profit right off the bat, right? Is that fair? And
Yeah.
that's exactly what we as investors say too. We need to. So hopefully, after this talk, we'll learn how to value the business and how to find that $100 bill and how to see if we can buy it for say $50, $70, whatever is a comfortable rate, right? Fair enough. So that's called the margin of safety. Okay. Um, here are some examples of some of the wonderful companies or the top companies in the market. Anyone sees some pattern here or something? Anyone wants to call out? Ash, uh, Ashish ji, I don't know if your mic works. You want to talk about it?
Yeah, Sanjay. Well, I mean, the pattern probably, I mean, I could, from at least from this data, I could see their market caps are really high. And also, I would imagine that these are going to stay in business for decently fair enough time, longer time. And I see some futuristic companies like Tesla, Nvidia, who are powering in their own space, like AI or electric vehicles, etc. And we do also have ExxonMobil, United Health, which are again like behind the screens. They are ExxonMobil, at least it's global, and people need power in the sense electricity, etc., whatever, and it's gonna stay in business. And United Health is behind the screen again. The whole pharma industry, government, everything work in unisync, and I believe United Health will also stay in business for a longer, lengthier time.
Very nice. Thanks for describing those companies. You have a pretty good grasp of those companies. I think like what you observe here is like each of these companies had like a 50% drop. Like 50, if you see, look at the 52-week low and 50 high, there's a 50% drop, right? You see that, right? So like there's company called the efficient market theory that says at any given point of time, a stock price on the market represents the real value of the price of the stock, right? So you see that in a year you'll see this company is gravitating from like like $100, $50, or $50, $100, right? Is everyone make sense, right? So if you had calculated the value of, let's say, Apple to be, let's say, $130, right, and you would have bought that, right, at, let's say, 124 that time when it went, right, you would have, and now it's like 190, by the way, but you would have made like a 50% gain, right? Fair enough. Is that good? So
Right.
market essentially gives this wonderful opportunities to buy companies. And if you look at this trend, you'll see it every year, right? Every year you'll see the 52-week and 52 will have like a 50% drop, right? So if you can time it, you can make 50% money every single day, right? Obviously, you'll pay taxes on that, but that's what is the opportunity. And the key thing is like you need to figure out the right value for the company, right? But going by the market theories, 124 could have been a value of Apple that time, right? Meta, Facebook is not here, but it dropped to $90, right? Sometime back, and now it's like $300, right? So markets can be crazy, right? As you see, right? Is that fair? So just to give an example, right? Like, right? I'll take Amazon as an example, right? Amazon dropped to $84, right? Is that correct? Right? 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 And now it's like 140, right? So, and we like this is like the recommendation from the system, but like you had this opportunity to buy Amazon at $84, but did anyone pull the plug?
Well, yeah, I just averaged.
Nice. So the challenge is the challenge with markets is no one knows, like cheap can get cheaper, right? Costly can get more costly, right? That's the beauty of market, right? So it can be crazy, and you have this wonderful opportunities where you can make a good amount of money. The only problem is you need to be confident and you need to have that gut to pull that trigger, right? To load up that stock, right? That makes sense. It requires a lot of confidence, right? And if you think of stock prices just as like a tickets gambling, then it may not work out. Unless until you understand the business, you won't be able to make that fat pitch, right? I don't know, like 3 weeks back or 2 weeks back, Cigna stock dropped 10%, right? just for a if condition. If you look at it, and after 7 days or something, it again popped back 16%. So that's how market gives you those wonderful opportunities. That okay. So this is the reason so when I saw this is the reason I started SecDiver. I had a lot of um, doubts on how to find things. I had a lot of I would say anxiety on I bought a stock, what would happen. I was sometimes very confident, but I would only buy 10 stocks, right? So I would and I was studying all these wonderful investors and what they were doing, and I figured out that I need to do something better with my process, right? And that's why I built SSD.com, which we'll talk about, right? And um, um, what we provide is like, we provide recommendations, we provide fair value estimates, right? And I don't know if anyone knows, right? This Everyone has heard, right? Amazon is a very high PE stock. Is that correct? Is that a fair understanding, right? But if you look at Amazon, right? Amazon was always priced on cash flows. So if you look at this last line, POCF, price to operating cash flow, if you look at for the last X years, right, it stays consistent about 25 plus. Do you see this number? Yeah? Is anyone able to see that?
Right.
So on 2022, it was 18 times. It was cheaper than its history, right? It was a wonderful time to buy. But if you look at the P multiple, it's like 100, 90, whatnot, right? It's very hard to figure out, right? So you need to know. As we go over this course, as we go over this presentation, hopefully we'll understand how to figure out these things. But just want to share an example. Is that good? Okay. So this is something that clearly touched me when I was looking at it. So I started stocks in stock like 15 years back, obviously with my Amazon stock that I got from Amazon. But I dabbled into Indian markets, lost money, came here, uh, joined markets here sometime, and I'm doing good. But again, I didn't have any education. But what I learned is like it's all about like money gets flowed from people who are impatient to patient. That's it. That's what happens, right? You just have to be patient and you have to go through those downturns, right? So let me ask you a quick question to everyone, right? What makes you buy a stock, right? What do you what lets you trigger, what is the trigger that makes you buy a stock, right? um and let me ask someone who joined. Ramya, do you want to share what makes you buy a stock?
I mean, definitely the ROI, right? I'm still yet to get into stock, so I'm looking forward to learn, hoping to get a better ROI than um, investing it somewhere else. It's one of the way to get better ROI.
Okay. Okay. Anyone else wants to share what makes you buy a stock? So definitely, you're looking for superior returns. Is that fair to say, Rameji? That
Right. That's what I meant. Thanks.
okay. Yeah. So I think like the biggest same thing for me. That's what I also entered the stock market. But I think when I entered, I somehow thought that you can buy and sell and then get 50% profit and get out, right? But as I grow over time, as you learn, right? If you treat stocks as those pieces of paper, you will not make a good amount of money. And I'll tell you an example, right? When I came to US in 2012, if you look at any of the good companies, right, all those companies are 5 times, at least 5 times, right? So stocks are more than that. It's like a ownership of a business, right? It's a part ownership. It's like just owning a home or any metal, or any gold, metal, or land, right? I'm not going to go into theories of what kind of investments are there. There are like 3 kinds of investments: fixed, yield, and no yield based investments. I'm not going to go over it, but stocks I feel provides the biggest value in the long term, and we'll see why later as we progress more. Okay. Uh, Again, like the biggest take I would say is like, don't think stock as just piece of paper that you made 50% profit and then you sell it. Keep it for long term, and you'll see why it's going to be a wonderful champion of growing your wealth with time, right? And then the second biggest best principle that I've learned is like buy with a margin of safety, and we'll talk about how to get that. um, Okay, so anyone wants to answer what drives stock prices then? Who have already invested sometime in the market? Anyone wants to, like, if I know someone had like at least 4 years of journey here. Like, anyone wants to tell what drives stock prices in the
Everyone believing that it will go up drives it up.
Mhm. Very cool. Pranabji says news. Yeah. Yeah. Please feel free to put it in the chat message. I'm happy that we can get everyone can learn from what everyone is looking for, and it's true, right? So as you see, right? Go ahead, Ashish.
Just I wanted to add one point. So probably I think what drives stock price is the guidance from the earnings, quarterly earnings. I think if one understands about a company's earnings, that would be giving us a basic understanding. Like there are multiple factors, of course, cash flow, what are they investing, if they are, spending it too much, etc. But then I think quarterly guidance will give one easy basic example.
Yeah. By the way, Ashish ji is a wonderful investor. He has
Oh, no.
50% CAGR just as a FYI. So he is a really his answers are superb. But we're gonna go over it. Okay. I'm gonna just echo in what Ashish ji just said. Right. So the key things that drive stocks in the short term and medium term and long term is like earnings, stock multiples, right? Like I will talk about what multiple means, and the changes in share outstanding, right? Like every company has a pie size, and if that pie size reduces, you're going to get more profits, right? Because now there's a lower number of people who are going to get the profits, right? So those are the three things that drive stock prices, and, and the biggest thing that drives stock prices is like earnings. It's the most important thing in the long term, right? If you look at any company, right, the stock price has gone in relation to its earning. That's it. Spirit. That's the only thing, right? But in the short term, you can have sentiments, you can have if conditions, you can have news articles, you can have many things, right? Right? That can go over it. Right? But in the long term, it's always earnings. And again, we'll see some examples how it does that. Thank you, Ashiji, for sharing it. Okay. So again, I hope I hope I've convinced you like to look at least stock as businesses, right? Right. And so now because we know and they're like 10,000 more than 10,000 business in the US and more than 100,000 in the world, right? Like there's so many companies, right? And like we cannot put all our time into each of those companies, right? So how do you find good companies, right? Right? What are some of the strategies we would use to find good companies, right? How do you filter on them, right? Because if we spend like at least 1 hour on each of them, it's gonna be a lot of time, right? We don't have that much time. We have our jobs, right? So how do we do it, right? So another way to think about it is like, and this is a mentor model that you can think, right? When you want to give your friends money, or when you go to the bank, or when you go to the bank to lend money, right? What do they look for? What do you look for when you loan people money? Anything you want to share?
Sorry, I missed the question, Chandanji. What was the question?
What do you look for when you want to loan people some money?
Your
Whether I
assets.
will get my money back or not.
Very good. Yeah, that's one answer. People, feel free to type out. Pranaji says reputation, right? Arvinji, thank you for saying repay. Yes. Feel free to type out. Okay. Again, I want to make sure this is interactive, and feel free to say it. Yes, you're correct, right? So, right? And right. So as I mean, like this is not exhaustive list, but like we at the end of the day, you want to trust the person, right? Will he pay my money back, right? What is the historical record of the person, right? Right? Does he have any debt or not, right? Like, is it a good character, right? Like, and as well, like, can he pay back, right? You cannot just say, okay, Chandan looks like a good person, is gonna pay back, but like, does it have a historical record of paying back, right? You need to know that, right? Fair enough, right? Similar to what we do, and I guess I don't know if anyone have you have taken a mortgage, right? Banks do the same thing, right? They look at your historical transactions, they look at assets, they look at how much your cash flow is earning, right? Is that fair? Yeah. Yeah. So same thing. Now, like, I don't know what people do, but when I was buying a stock, I would not look at any of these things. Some one of my friends recommend me to buy a stock, I'll buy it, right? Okay. Oh, this electric vehicles is exciting, right? Or battery technology is exciting. Let him buy it, that stock, right? Or Bitcoin is doing wonderful, right? Does anyone does it echo with anyone? Or Wall Street Bets is saying, right? Does it echo with anyone? Right. So the key thing here is when you buy a stock, right? When you buy a stock, please try to do the basic due diligence in terms of like seeing can you trust the management, right? Who runs the business, right? Because they are third party people. They don't know, you don't know them, right? They could be having parties on your money, right? You're giving your money when you're buying a stock, actually you are providing your equity, your money, your hard-earned money to the stock, right? To the company, right? Right. So you want to do some due diligence on that, right? Is that fair? Right. So again, I'm not again the biggest thing for me is skin in the game. I want the management to own a good amount of stocks, because if they own at least 10 times or 20 times the overall net worth that they have in stocks of the company, I'm pretty sure they won't do a bad job, right? Right. Will someone um, making their home put a bad concrete in their home? No one will do it, right? Is that fair?
Yep.
Yeah. So again, there's something, or there are this three kinds of information that any company provides you. One is the financial information like balance sheet, cash flow, uh, income statement. But I feel proxy statements are some of the wonderful things. That has anyone looked at a proxy statement? Does anyone know what's a proxy statement?
Nope.
Yeah. So proxy statement is a statement where companies management have to tell about their holdings, how they are paid, and what were the incentives by which they were paid. Their compensation was determined, right? And how many stocks do they own, right? So that's a very key thing, because at the end of the day, you're giving your money to someone, right? You want them to uh, do a right job in handling it, right? Fair. So please look for those things, right? Right. So again, like, so the key message here is like you should buy wonderful companies with wonderful management who are skin in the game, right? And with low debt, right? Right. I don't know if anyone knows Jaspal Bhatti, famous, like a comedian, right? So I will encourage you to see this video later. But he talks about like there are some companies who are fraud, right? Who are fraud, and they would take money from you. They will keep that in stock, and they'll run away, right? And you never want to go and invest in such companies just on the promise that they would be great, right? So it's a wonderful video. I would encourage everyone to see, right? Uh, so yeah, so we all agreed that okay, something is a wonderful company, wonderful management, but at what price, right? Right, and why, right? Like, let's say someone says, okay, your Snow Colony apartment, I'm gonna. This is Seattle is a wonderful area. I want to. And you come and all the houses are being sold there for like let's say $1 million, and suddenly someone says, I want to buy it for $10 million, right? Right. That would be crazy, right? Right. Is that fair? Right. So again, there's a small video that I would like to see.
Audio is not on.
Is everyone able to hear the video or not?
No, we
No.
cannot hear.
Oh, that's bad.
No.
I don't know why, but basically it's talk about Amitabh Bachchan buys a building for like. Are you able to hear me now? At least. So
Yeah.
Amitabh Bachchan buys a building of 1 lakh, building worth 1 lakh at 10 lakhs, and he says, "I did it because my mom worked here some time back, and it's a tribute to my mom." So everyone could have their own reason to buy it, but as investors, our reason is very simple: we want to make money out of it, right? It's not like any sentiment or something, right? Make sense? So it's very important to buy at the right price, and we'll talk about how to determine the price as we. Here's an example. So long time back, 600 BC back, there was Aesop. He's a famous. I don't know if anyone heard of Aesop fables, but he said, a bird in a hand is worth two in the bush, right? This is the most simplest or early dated valuation principle that was laid down in history books, I would say, right? And if you look at it, right, the only thing he missed was like what were the interest rates and time, right? How long I have to wait to get those two birds, right? Right. If I give you one bird, how long I have to wait to get these two birds, right? If someone says the interest rate is 5% and you will get two birds in 20 years, do you think it's a good investment? If interest rates are 5% and you get the two birds in 14 years, do you think it's a good investment? Does anyone know the rule of 72 by any chance?
Yeah, it doubles the money, I guess. That's what it is.
Right. So in this case, if you 72 divide by 5, you will get like 16 plus, right? 14 something, 15 plus, right? Something like that, right? And so the first will be like a no, right? Because you have to wait 20 years to get twice the money, right? But at 5% interest, you should at least get within 14.5 or something, right? So the second one will be like 14.5 years, so it will be subpar. And if interests are 10%, right? So you'll double your money in 7 years, right? But you're getting the two birds in 5 years, right? So the third is a much better thing, right? Does that make sense? Is it clear? This is very important. If everyone doesn't understand, let me know. Why the third one is the best investment? Make sense?
Can you explain one more time, please?
Yeah, so let's take the last example, right? So you know the rule of 70, right? So if you know interest rate is 72 is 10%, right? If 72 divided it, if you keep adding 10%, let's say you're $100 and you keep adding $10 each, right? In 10 years, you'll make it 200 at simple interest. Fair enough? In 10 years, it will double, right? Fair enough? But
Yeah.
because of compounding, that will shrunk to 7.2 years, correct?
Yes.
So if someone says, I'm going to give you double the money in 5 years, it's a better investment, right? Because you will typically double your money in 10 years. You will double your money in 7.2 years otherwise, right? So
That
it's
is
a
compounding.
investment. Fair enough?
Got it. Okay.
So that's the idea. So again, just to give you another example, right? Like say you have a stock, which is let's say there's a very good company, you know for sure is going to give you 5% interest, right? And there's a government treasury that's also giving you 5% FD, right? Like interest, right? For the next 10 years, right? What would you prefer to buy? Dharamji. And even people feel free to type your answer on the chat message. Right. So again, both are giving 5% return. The only thing is in the treasury's case, it's a guaranteed fixed return 5% every year. It won't be growing. But in the case of a stock, the good thing is as the company grows, you're going to grow with it, right? It can also drop, but again, we started with the fact that this is a wonderful company. It's gonna consistently give us 5%. Right now, it's yielding 5%. So a better value of in terms of time would be like to invest in the stock. Right? Does it make sense to everyone? Why? If it's like same percentage return, yeah.
Yeah.
And so and again, I'm stressing on the fact margin of safety. Margin of safety is important because in this case, you are not running the show. You don't own the business. You cannot command the other person, hey, do this, right? Because it's some third party person or third party management who is owning the business. If someone says, I'm going to double your money in let's say 5 years, right? And based on the compounding factor we just talked about, right? It's going to take 7.5 years, right? And if we say 7 years, you wouldn't invest in there, right? Because that's just 0.5 years of margin of safety, right? You want to have like 5 years. Make sense? Because you don't know what they will do, right? Fair enough. So margin of safety is very important in those times, right? That way, if he does something bad or he takes away money, at least you bought it at a little bit cheaper price, right? That's the idea. So now coming back to original thing, right? We talked about so many things, right? Like, okay, there are 100,000 companies in the world. We don't have time. So how do you find good business, right? We want to buy companies that can consistently generate the same yield or beat the yield that the government bonds are giving us, right? Like right now, in this case, we're getting treasury yields of 5%, right? So we want to buy companies which are generating guaranteed 5% yield for the next 10 plus years, right? Right. And how do you find such companies? Right. Anyone wants to, like, feel free to write what would you look for to find such good companies. Again, please feel to type, and if anyone wants to speak up, I'm fine. I would love to get inputs on. Okay, everyone is shy. What would you look for? P ratio. Nice, Albert G. What else? That's a good one. Okay, so let me ask you in a different way, a different model, right? Let's say, and you can read the examples there, right? Can you tell me which of these are good businesses? So let's say you have a 200K investment in local restaurant that pays you $50,000. Is that a good investment, Ashish ji, as per you?
What happened? I mean, like 50,000 a year, and it goes on forever.
For now, let's assume that. Yeah, just for now. Yeah.
Yeah. Why not?
Right. That's how much? Like, that's like a 25% return. Is that fair?
Yeah.
Right. Okay. Right. What about the second one? Chitra ji, what about the second one? Okay, in that case, it's a 30%.
Oh, sorry, I couldn't mute. Yes.
No worries.
Yes.
So in that case,
Second one is on the 3%. Yeah, a little bit lesser. Oh, yeah, it gives $300. Yes, so $300,000 per year. Yes, that's very good. 30% investment. Yes.
yeah. So as you see, the key metric is like return on investment, right? How much money you're putting, how much money you're getting back, right? It's always a ratio. So you should never look at like the number, like, oh, someone will say, oh, this business is generating billions of dollars of revenue. Okay, but at what investment? That's the key thing. It's always a comparison, right? So the most important metric that you need to look when you are buying a business is return on investment, right? ROIC or ROC. There are many terms for it, but it's return on investment, right? Right. So that's the single metrics that you should look for, right? Again, I'm going to jump over it quickly, but that's how you could calculate it, right? In the stock market parlance, right? That's a formula for it. Before I go there, right? Let's say your expectation is to make 15% from the market, okay, every year, okay, for the next 10 years, right? What business would you buy? What kind of things would you look for before buying it? Anyone wants to speak up or type it there? Okay, today we are less interactive. Growth, nice. Thank you. So I think the most important thing, yes, growth is one factor, but the second important thing is, like, is the business earning 50% return on that on its current investment, right? Because if you want 50% growth every year, 15% growth every year, right? You want the business also to generate 15%, right? Obviously at a growth, right? Right. But at least then only that $100 will produce $15 of net profits, and that $15 can be reinvested in the business, right? So you want a business that can reinvest its capital at the same rate it's growing, or more than that, right? Right. If from 50% goes to 20%, that's wonderful, right? That's like the best to happen, right? So here's what will happen, right? If you buy businesses, let's say if you buy a business that has a return of capital of just 5%, right? In 30 years, it will be 4 times. Does it make sense, everyone? Right? But if you buy a business that has a return on capital for 15%, right? In 30 years, it will be 66 times of your capital, right? Isn't that wow? Right? What if you pick a business that has 30% return rate, right? That will be like 2,600 times, right? Does it make sense? Does that make sense to everyone? Yeah. So essentially, what you need to look for is, like, before you buy a business, before you buy a stock, look at its return on investment, right? if you are expecting 10% return, your business should at least produce more than 10% per year on investments made. Never buy investments that are making like less than X%, right? Less than what you're looking for, right? And again, we talked about rule of 72, but like just to take an example, right, of a bamboo tree, right? And before I go into the example bamboo tree and kids, you'll see, right? Um, if you would have bought that stock and kept it for, let's say, first 10 years, right, you would have made 13 times of your money. Fair enough. So you'd say, oh, Chandan, I made a wonderful money on this, I'm going to sell it, right? But if you see, right, it's actually in the last year you made 2,500 times, right? Is that correct? In the last 10 years, right? So compounding is something which basically kicks in the very last stage. The more you give it time, the more it kicks out. Does it make sense to everyone? So there is a very famous example of bamboo tree, right? A bamboo tree takes 5 years just to come out of the sprout. Like when you plant it, it just takes like 4 to 5 years to Chinese bamboo tree just takes 4 to 5 years to come out, right? But when it comes out, right, the next 1 year it just goes to 80 feet. Right? And that's the beauty of compounding, right? And so if you can find a business that can grow every year at X% rate, right? At that rate that you're looking for, and you know for sure it has a high runway, right? Then you can see the growth rate. You don't need to go anywhere, right? You just can sit and relax. You just have to monitor business every time. Make sense? So our idea is to buy businesses that are gonna be there for the next 30 years. If a business is not there for the next 30 years, I would not even touch it, because that's how I look at it, right? I want it to be there for the next 10 plus years at least, right? Otherwise you're not investing, right? As we talked about earlier, right? Again, same with our kids, right? I don't know if I've seen my boys grow up, right? And now they can speak a lot, right? After 5 years they speak a lot, right? And we parents teach them ABCD, and you tell them a lot, we then calm down, and then at 5 years we'll say, oh no, this kid talks a lot, right? We need to stop him, right? Don't we see that, right? Is that correct? Right? So again, and then they become 18, they're gonna be it's gonna keep compounding, right? That's the beauty of investments, right? Here's an example, right? Sorry, Manjuji, I came late on this, but like if you had invested in the stock market and you just invested $10,000 50 years back, it would have been 700K today, right? Correct? Fair enough, at 9% interest rate, right? But if you bought a wonderful company like Apple or something, right, which had just given you 12% interest, right? So remember, market is going at 9% interest, and just that 3% spread is gonna make your $10,000 grow to $3 million versus the index of 700K, right? And that's why buying wonderful companies is a much better chance of performance in the long term. Does it make sense? Okay. Okay. So again, just to conclude the takeaway, right? Like if you want 10% return, you should buy businesses that have a return on investment of more than 10%, right? If you want 20% return, you want to buy business that have more than 20% return on investment. Does that make sense to everyone?
Yeah.
A simple filter? Yeah. Again, in the long term, not in the short term. Short term, anything can happen. In the long term, a business has to go, because if it doesn't go at 20%, it won't compound at 20%, regardless of what you do. Again, so as I said, like it's all about understanding that it's a business, you own it, right? It's not gambling, and you want to buy business that have a high return on capital, right? That's the biggest thing, right? So then, like, how do you value this business, right? Like, how do you figure out what's the right value? How much money should you pay for the business, right? And the most important, like the textbooks scenario on how to do those valuations, like you calculate how much future cash flow you generate, and you just like do present value of those stores, right? Is that fair? Right? So let's say there's a business, let's say Ashiji is selling your business. Ashiji, let's say you have a business that's generating $1 million of profits every year, okay? Net profit. And Chitraji comes and tells you, Ashiji, I want to buy a business, right? Chitraji, how much would you pay for that business?
Depending upon the value of the business.
It's generating $1 million every year.
Oh, 1 million. Okay.
1 million
Generating $1 million a year. Okay.
every year. Yeah, it's guaranteed. Ashish is a wonderful person, so his business is generating wonderful money. No doubt about that.
I typically, my rate of return, I'm happy if it is more than 15 or 20%, 15%,
So right now, let's assume that the rate is good. Like we have crossed
Yeah.
a wonderful business character. So we agreed that Ashish's business is wonderful. We agreed that. Now we just talk about valuation, like how much price to pay. Once we know the profit that's coming, we have to calculate how much money we should pay. So in every year, Ashish's business is going to generate $1 million. We are guaranteed that. Okay, let's
Mhm.
assume that.
Mhm.
It's like a FD, right? But how much now Ashish is trying to sell his business, or we have to convince him to sell his business. So how much would you pay for it
See.
right now?
He's trying to sell the business and it generates $1 million, and you are
He's not
asking me.
selling it, but yeah, he
I mean, I'm just saying,
wonderful
yes.
person. Yeah, he know that.
I'm willing to buy it 7 million. I don't know.
Okay. Ashish ji, would you pay 7 million for? Would you sell it for 7 million?
No, if it is generating $1 million an year, the growth potential is much higher than 7 million valuation.
Right, and wonderful. That's exactly what that's what happened, right? So, but Ashish ji, if someone someone comes and says, let's say Chandan comes and tells you, I'm going to buy a business of $100 million. Would you sell it?
Would I sell it? Well, I don't know.
Good. What about 50 million?
I'm not sure either.
10 million?
It's going down.
Yeah, 10 million. That's what.
No, offer is going down.
I know. So I'm asking, will you sell it for 10 million? I
No.
increased by 3 million. No. So
No.
are you seeing, right? Like Ashish ji said, don't know to me at 100 million, 20 million, but at 10 million and 7 million, he clearly said no, right? Do you see that? Does everyone see this?
No, but if Chandanji, if there is no growth, are we anticipating no growth in the business, or we are expecting growth in the business?
Right now, we are not anticipating, but we'll talk about growth as a separate model. But we're not anticipating growth right now. We're just simple. We're
It's
keeping
just
it
1
simple.
million. Okay.
Yeah. So, but
So-
the thing that I wanted to showcase was like, given a business, you can figure out the floor value for it, right? Like in Ashish ji, he clearly says he will not expect less than $10 million bid. Right? Is that correct, Ashish ji?
Yeah.
So my goal behind this scenario was to tell you how to figure out the floor price, right? So tomorrow, if a business falls to the floor price in the stock market, you should at least buy it. Make sense?
No, but how do you figure out that? I didn't get that.
We just talked about it. So we started with Ashish is putting $1 million of profit, right? And Chitraji offered $7 million. He said no. I offered $100 million. He said I'll think. $20 million. He said I'll still think. I asked him $10 million. He said no.
But that's gut feeling, right? I think.
So essentially in his mind, what he did was he said, okay, I want my business to double in 10 years or something. He did some calculation, right? So in his case, right, he said he's going to get anyways $10 million in next 10 years, right, from his business, right? And why would he pay for $10 million, right? He would want like at least double of it or triple of it, right? That's I'm telling it from Ashish's beer, but that's what we're thinking, right? Because you want to own something, because for him it's established business. He's going to get $1 million regardless, and if it grows, it's going to grow more, right? So it's going to be more valuable, right? Coming back to Nitinji's point, right? But what I wanted to tell you from this example is like our goal. There are some times in the market where stocks fall to the floor price, right? As we went to the very third slide there, right, where we had the 50%, 52-week, 50 and low, right? We saw Amazon went to $84, right? Or Microsoft or Apple went to $124, right? Those were some of the floor prices, and they were really cheap that time, right? Meta went to $90, right? So if we can figure out the floor price and we have the confidence in the business that it's going to stay for the next 10 years, right? As Ashish was saying, then why would we sell it, right? But if we are the buyers, we should buy it, right? We should jump on the opportunity. Does that make sense, everyone?
But the floor price could be different at different point, at different time frame, right, Chiranjeev?
No need to. There's no need. We just give a scenario. This is a wonderful business. It's going to produce $1 million of profit every year. We know it. And we have a historical record, right? Ashish has given us last 10 years of record. that the business has produced $1 million revenue. So we know it's going to produce $1 million revenue. The customers are already logged in.
But if the growth is decelerating, let's say this year, for past 10 years, it's been making $1 million every
Mhm.
year. But now, it's anticipated that the growth will slow down. It will make 800,000 next year, and then slowly it will slow down. So then what would be the price?
Very good question. So again, it's a if, right? Nitinji, no one knows, right? Like, by the way, all forecasts have problems, right? No forecast is correct. I don't know if you know about it, right? So it's a prediction, right? It's a if, right? But we have history record, when we can look at Ashish's track record, we can look at the business performance. We have all the data, right, to calculate that, right? So if we have confidence in the business, right, it wouldn't drop more than $1 million, right? Because we know every customers love their product. Like, let's take Costco as an example, right?
Right. Costco, for example, is going to grow, we know. But
Not about
let's
growth,
say,
not about the growth. So, like, going back to your question, right? The if will be there for any business, right? Because this is capitalism. Company is gonna invade, right? If you gonna become a better company, companies gonna invade. But if these companies have stood the test of the time and they are being inventive, if you know from their track record, if you know their customers are captive, they're not gonna go anywhere, right? And those are some of the qualities I didn't look for in a business. And by using example of Ashish, I was trying to say he's a wonderful investor. We know it. He's going to make $1 million, right? So we know for sure, right? So we look for historical properties because
correct.
ahead no one knows, right? Even the economist doesn't know it, right? Today Powell said he doesn't know, right? But he just maintained the he didn't want to. He wanted to increase the rate, but people like other people didn't want to, right? So the Feds came up with like this next 3 quarters they made 3 drops, right? And so the markets rose like 1.5% 2% today, right? So you even like no one knows what's going to happen with inflation, right? So future is unknown, right? But the idea is look at the what I want to pass on this message is like we need to be able to know the floor value of the stock, right? So we should be confident with the floor value, and the only way we can get the confidence floor value is if we know for sure that business can produce the same amount of money every year. And there are some business, I'm going to show examples which have consistently produced that much money or more than that. So the
Okay.
idea is to get the normalized. So what you do is you get an average for the last 5 years, and you can say, hey, this is the normalized it's going to get, and then you multiply by 10. Got it? Or whatever you know.
Perfect. Thank
Is
you.
that fair? So the idea, like the message I want to pass from is like we just learned Ashish is saying no for certain rates. So if the market falls below that no price, please jump on. Don't wait for it. Okay. And there will be chances for that. Okay. Okay. I'm glad. So we good, right? Fair? Okay. So again, the formula is this is the formula. You add all the future cash flows and you do present value calculations. And I can share the Excel sheet with you later, which shows all that. But that's what I did with you. I added 1 million plus 1 million for the next 10 years, multiply and I did simple compounding, simple interest, but you can do compound interest, right? Okay, so another way to look at it, right? So let's say a bank, let's say in the previous world, right? When there were 1% interest, there's a bank comes and says, I'm going to give you 5% interest, right? And what you do is you put $100 in the bank and you are happy to get 5%, $5 next year. Is that fair to say? Is it good? Because all other banks are giving 1%, right? So this is a good bank, right? It's not lose money, right? Is that good? But so we are happy to give $100 to the bank that time, right? Because we know it's not going to go, right? But if a business comes to you and says, I'm going to give you $5, which is like 5%, give me $100 today. Do we give it? We don't give it. We think a lot. Right? So if we treat businesses like fixed deposit, or if we can find businesses that behave like a fixed deposit, then we should just latch on to it when we see they are wonderful business, like the ROS, the return on capital is wonderful, and they are generating this fixed yield or growing yield, I would say. Are we good? Does this example make sense? Anyone has questions on that? We are almost on time. So this is what I did, present value calculations, right? Let's say there's a $100 that's going at 10% rate. And there's something called a discounting rate, which present value uses. And if you compound it, right, you're going to get basically, so if you put $10 in the bank, it's getting 10% interest. That you're gonna get $100 back the same year, right? The next year, right? So every year the present value calculation is gonna be same. Is that good? But if someone says that $1,000 that you invested, I'm gonna get it for $700 today, you should be able to buy that today. That's what will happen with stocks a lot many times. Okay. I'm not gonna go over this quickly, but there are essentially two ways of calculation valuation. One is absolute valuation, which we just did right now, right? Which Ashish just gave an example, right? And the second is relative variation, relative, which is like what was this business as compared to its previous years? What is this business compared to index? What is this business compared to its peers, and so on, right? Price or price multiples, right? So you should look at all that later. First, you should do absolute calculation. Like let's say I bought this Apple iPhone, right? I know it's worth $700, right? But if someone goes and says, I'm gonna sell you the Apple iPhone for $350, would you buy it? Come on, say yes. It's a brand new iPhone, right? It's 40% discount, right? Today, right? You'd buy, right? You may have a little bit of check. You may do a little bit check whether it's a real device or not. But you should, when Target is selling, you should buy it, right? Is that good? Or Amazon selling, you should buy it, right? Fair?
Yeah.
Yeah. So that's what will happen in business over a time, right? Again, these are some of the profit terms you should look for. I think there are, so as I said, like, so now we know, ROIC is basically profits or investments, right? So these are the way these are various definitions of profits, various categories of profits. But the only profit that I will say everyone should pick into consideration is like cash flow profit. That's the real profit. That's the real cash, and we can have a separate exercise to see why we should look at cash flow profit. Not for the time right now, but there are various kinds of profits, and cash flow profit is the right profit to look at. Okay. So here's my philosophy. My goal is to not lose money. So first, I want to make sure I buy companies at the floor price. I want to make sure the company has no debt. The management is wonderful, and then only I want to buy. Right. So first come risk, then quality, and then the price. Right. And then you just look at all those companies every single year. Whenever those quarterly documents come in, and you keep checking on that. Right. Are they improving? Like as Nitish was asking, are they decreasing their revenues? Are their earnings growing, like that, right? So you keep a pulse check, but you don't sell a business tomorrow. Oh, it went twice my expected return. I bought it for $100. It's $200. Don't sell it. Does it make sense? If the business is also growing, let's say the business when you bought was earning $10, and today it's earning $20, so it has a multiple of let's say 10. So it will be 200 price today. Don't sell it because just because it doubled, right? Just remember the earnings also grew double, right? So it's okay. Just keep holding on it. Does it make sense to everyone?
Yes.
Yep.
Right. So always do it in relation to what earnings it has, right? Sorry, I don't have those graphs right now. May do it in some other presentation. But the key thing is like what I like. The key message that I want to pass is like, first, don't buy a stock because it will double. First, buy a stock because you don't want to lose. You want to make sure you don't lose money. Okay. So always buy with low risk, right? If a stock has a lot of debt, don't buy it. It should be because tomorrow debtors will have the first role on taking it, right? I'm going to pause here, but again, as I said, like, don't lose money, right? And this is a wonderful quote from Joel Greenblatt. He says, I don't buy the more of the ones I can make the most money on. I buy more of the ones I can lose money on, right? Right? And if they grow, the upside is already taken care of you, right? Is that good?
Yes.
Okay. So, and I'm jumping through a lot of things, but again, like as I said, like, thank you for coming. And again, my goal is to make a sounding board of people who are looking for doing wonderful investments, and I'm here to help. Give me feedback, or tell me what we can do better. Tell me it helped. It was a if it was it at least spiked your curiosity of investing in stock markets. What are some of the gotchas that you want to learn, or it helped you a little bit, right? Do share it. Okay. I have a lot of quizzes planned, but I think we are out of time, so I'm not gonna go over it. But any questions before we close off?
Great job, as always, Chandanji.
Yeah, thank you, Chandanji.
You should do one quiz at least.
Yeah, we can do. I can spend some time in doing some quiz. I'm fine with that. But like I want, and we can. Nitinji, you wanted to see the website, so I can start with that if you want. But I want to make
Today
sure
or next
it's
time?
9:30 right now. We're gonna yeah. So I mean, I don't know. It's gonna be late for people, so we can probably do it later.
Yeah, we can do a follow up. Yeah.
Let's do a follow-up, Chandanji.
Okay. Cool. Thank you, everyone. Then
Thank
see
you
you.
so much.
Thank you.
Thank you, Chandan. Yes.
Thank you, Chandan.
Bye.
Stop.